and YouTube. Let me know. Then I'll start.
Okay, sir. Sir, social medias I unmanaged, sir, live stream.
Social media. Okay. What about webinar live and YouTube?
YouTube, Facebook, website, webinar started, sir.
Started. All we are live on air for all the 4 segments.
Yes, sir.
Thank you. Another minute, I'll go. Very good morning, ladies and gentlemen. Very warm welcome to another edition of our webinar. As you all aware, since the time the lockdown has been declared last month, 25th, we have been continuously bringing in great events for you from morning till evening to keep you engaged intellectually. We have started with yoga in the morning. Now we are tied up with Isha Yoga to bring you some series of programs. You must have already got your inbox. Thereafter, morning 8 to 10, we have a quizzing and where the quizzing has become really very popular. We started with the bandwidth only for 500 people. Now we are taking it already 1,000 people every day. If it's delayed, we have been asked a lot of questions why the questions are not come for the day. And we also picked up some outstanding quizzes, and I'm quite sure you get addicted to the quizzing. It's a great habit. And thereafter, every morning 11 o'clock, we will bring you some outstanding thought leaders. One such program is going to happen a short while from now, and today we made it 10:30 for the convenience of the speakers and viewers too. And every afternoon, midday, we give you a business puzzle. That's also become very, very popular. I could see a lot of people attempting correctly, and we don't know how to decide the winner. Afternoon from 2 o'clock to 5:30 in the evening, we are offering series of workshops, certificate courses, which has also become very popular. We really wanted you to learn, unlearn, relearn. This is a time to reskill and introspect yourself. And 6 o'clock in the evening, again, we are bringing out some outstanding speaker to speak to you. And we also sharing with you some outstanding articles written by great leaders, so that we want to keep you engaged all through the day. That's our objective. And with your support, we have been able to achieve our objective. And coming to today's event, before I speak to you about today's event, I briefly tell you in a minute what's happening next 3 days till 3rd. What we are lined up for you today at 6 p.m. We have an event on COVID-19 stress and mind management by Swami Nicholas Anand. He is from Ramakrishna Mission, Rajkot, Gujarat. He is an outstanding speaker. You can see him regularly in various forums, including TEDx. And please do watch in, and you will really learn some tips how to manage your self-stress. Tomorrow morning, 1st May, at 11 a.m. tomorrow morning, we got 3 outstanding speakers to speak on the subject socio-economic implications of India healthcare response to COVID-19. We have got Mr. Sharvan Subramaniam, is the MD of Roche Diagnostics. Along with him, Preeta Venkachalam is a partner of Rich Spam and Group, and also Aarti Sivanand is a partner of J Saga. She's going to be in conversation with them. The same evening, tomorrow evening at 6 p.m., we have got again an outstanding event, Marketing for the Future, by C.K. Ranganathan, who is the Managing Director, Founder, Managing Director of Cabin Care, who is going to be in conversation with David Appasamy, who is going to ask him so many questions, how the SMEs and the industry should look at the marketing. What is going to be the future of marketing? And you know, CKR is always innovative mind. You can get some great thoughts great insight from Mr. CKR's talk this evening. On 2nd May, we have again event on success story, how it was done, Silambam 3000 years. And we have Mr. Bharat Bala, who is a screenwriter, producer, director, who is the one who produced a great movie of Vande Mataram. He's a very passionate person. And along with him, Aishwarya Manivandan, who is a world Silambam champion. She's going to talk to us what really made her take this profession of Silambam. On 3rd May, we have been doing different type of activities. We also bring in politics to you. We thought on the 3rd of May, we have COVID-19 impact on Indian politics. 3 outstanding politicians are going to be coming and sharing their perspective. And we have from the state perspective, Pallanivel Tyagarajan and Maafai Pandirajan. And on the national perspective, we have got Hemant Chandran, Member of Parliament in Kollam. We want to know what exactly the federal system, the state powers, the political system, with the insistence on social distancing. There are going to be a lot of changes going to take place in terms of old way that we are going to look at it. So that is why we want to bring in this interesting event for you. Please keep login, watch it. If you by any chance not able to watch it, not to worry. All these programs are available for you to view next 1 year in our website. We'll also put the transcript and share with you the content as soon as possible. Thank you so much for joining us, and I warmly welcome all the viewers who have joined us on Zoom. I know many people are going to join soon because we have only 100 vacancies in Zoom. Then also all the viewers watching this program live on YouTube, Facebook, and our live webinar. Very warm welcome to each one of you. As usual, if you have a question, please type your question, send it to us. All those who are watching on Zoom, please put your question in the chat box. All the three panelists, we have some outstanding panelists today, will be happy to handle. Let me have the privilege of introducing the distinguished panelists for this morning. Mr. Seshasayee. Seshasayee is a chartered accountant, started his career with Hindustan Liver in the year 1971, joined Ashok Leyland in 1976, became ED Finance, elevated to Deputy General Managing Director in 1993, and MD in 1998, Executive Vice Chairman of Ashok Leyland India 2011. He is presently the non-executive chairman of the company. During his tenure as MD MD of Ashok Leyland, increased the turnover by 5 times from 2,045 crores to 12,093 crores, net profit 30 times, and market cap 14 times, which is outstanding, and we need his input during the difficult times. Shesh has been a chairman of IndusInd Bank since 2007, and Seshasayee is also presently is a vice chairman of Hinduja Group with a global presence in banking, finance, automotive, infrastructure, specialty chemicals, and much more. Was also on the bank board of ICICI Bank, Infosys, was the president of CII in 2006-7, was also president of Siam in 2001 and 2003, won many honors and recognitions, including Lifetime Achievement Award from Institute of Chartered Accountants of India. Very warm welcome to you, sir, and it's indeed a privilege and honor to have you with us. Let me have the privilege of introducing our co-panelists for this day today, Mr. Dr. Kamakodi. Dr. Kamakodi is MD and CEO of City Union Bank from the year 2011. He's a BTech from Chemical Engineering and MBA from Chinese University, Hong Kong PhD, and also done his CAIB. He has been in the banking sector for quite some time, and he has taken City Union Bank to its excellence by virtue of his technical know-how and by virtue of his reaching out to the customer. And I think City Union Bank is known for its technology presence. Very warm welcome to Mr. Kamakodi. It's indeed a privilege to have you with us on board. And I must thank Mr. Viswanathan, editor of Industrial Economics, who facilitated this event for you this morning. Let me have the privilege of introducing Mr. Viswanathan. Has been very longly associated with Madras Management Association. He is always a mentor, well-wisher, advisor to us. It's always an honor for me to introduce Mr. Viswanathan. He's a postgraduate in Maths and Political Science and teaching at Madras Christian College for a couple of years. And what made him is document for the magazines and reporting made him start a magazine, Industrial Economics, in the year 1968. He had visited a number of projects all through India to write special issues, special articles on the project. Mr. Viswanathan also covered the PM's visit to Washington in 2005 and was a part of the PM's media delegation that visited the Finland and USA in the year 2006. To be a part of the PM group, you have to be an outstanding reporter. This is what is proved by his visit along with the PM. He also interacted with senior leaders, chief ministers from a number of states, presented their perspective, their reporting on each of the states. The Golden Jubilee of Indian economics was celebrated recently with a day-long seminar, which I was out of privilege to be part of it on the India in 2030. And over 40 entrepreneurs and 40 policymakers addressed in this conclave, and which was an outstanding event. And we also wish Mr. Viswanathan many congratulations on the Golden Jubilee of the thing, and wish you many more. Very warm welcome to each one of you. The format of the event is the fireside chat. Mr. Viswanathan will be in conversation with the two outstanding speakers. And if you have any questions, please, as usual, put in your chat box, and we'll be more than happy to pass on your question to the speakers to address your concern. Over to you, Mr. Viswanathan. Over hearing you.
Thank you, Vijay. It's Nitya Kalyanam as usual at Madras Management Association. My congratulations to you and your team for maintaining and even improving upon it during the COVID days. Congrats again. Good morning, Shesh. Good morning, KK, and our listeners in various media forums, forums. 1968 was important to me as my publication was launched in that year. It also, surprisingly, was a big watershed for banking, Indian banking. Social control of banking was introduced by Indira Gandhi during that year. A year later, 14 major banks were nationalized. The course of banking through the next 52 years is in sync with the growth of my own publication, my own career. For somebody quite not related to journalism, picking up an economic journal and venturing into this as an upstart with no startup faculties available in those days. It was an interesting journey made possible by totally and almost continuously by banks funding the various aspects of my growth. Prior to industrial economists, for 6 years running trade journals, banks then were just collection agents. You deposit your check and on realization and taking a bit of their commission, they were allowing you to draw money from your own funds. There's no question of overdraft or any term loan or other facilities. In 1969, I was keen to graduate a year after launching IE, graduate from my two-wheeler days to a car. And my friend at Indian Bank, Tinagar branch, when I approached him, he said, there are no provision for this. My other bank also said the same thing. But he hinted that the all-powerful secretary, who was the CEO of Indian Bank, can help and decide. So I took an appointment with him the next day and met Mr. Balchandran, who was the secretary, who was the deciding authority of the bank in those days, in his sparring room. And when he looked up at me and asked me the purpose, in just 2 minutes, I presented my case in a torrent of words, without taking even a breath. I said, I have the invoice from Standard Motors for a Herald car that costing 18,000 rupees. I have only rupees 6,000 to invest on this. I needed 12,000 rupees. I can repay it over 48 months at rupees 250 per month. And the bank doesn't have much of a risk, as they were releasing advertisements worth rupees 3,000 a year. The sergeant banker looked at me up and down. I was 31 then, rather lean. Looked at me, and then after a pause said, take it. That was the beginning of my tryst with banking. The entire course of my growth, I imported machines for printing from Germany and the USSR. I imported spares from Italy. I imported newsprint from Finland. I expanded into computers and office equipment. And later, even the margin money I didn't have to acquire the plot in India Estate, and that was also funded by the bank. And even my building economist house was constructed by L&T with bank funding. So the transformation from class banking to mass banking, heralded in 1969, was responsible for new class and middle class entrepreneurs or startups with little or no resources. And the growth in the subsequent 5 years of banking has indeed been phenomenal. That young, educated men and women recruited in thousands, the quality of banking and also the quantity of banking expanded manifold. After liberalization in 1991, there was also the welcome entry of new private banks. By the end of 1990s, we also had retail banking flourishing at a phenomenal speed. We had easy loans for cars, vehicles, we had easy loan for housing and all. So that momentum continued for the next decade or so till about 2010. And then started the problem of the banking woes. These are caused largely by lack of proper oversight and regulation on the one hand, and indiscriminate lending without much verification of the security of things. And things continued unabated for the next few years. And signs of reforms were seen over the last 4 or 5 years when attempts were made to reach banking again to the masses through the Jan Dhan Yojana and all. And 1 crore of new people were brought into banking. But then the conditions were not conducive, non-performing assets were hitting the roof. And the government was preparing after the last elections for major reforms like consolidation of banking and even privatization of banking. At that unfortunate point, COVID-19 surfaced. I stopped here. I thought the better person to describe the impact of COVID and also on not just on banking, on the economy as well. An expert like Seshasayee, who brings with him enormous expertise and reputation for reforms. And he is also actively involved today in many of these suggestions he has been making to the government and others for bringing about the needed reforms. Shesh, I request you to describe the situation pre-COVID-19 and immediately the aftermath of it, how it is like.
Thanks. Good morning to all of you. Looks like MMA is even more than before. I'm sure that you're all enjoying all the programs being put together by MMA. I'm very happy to be a part of this event. Before I start, a couple of small corrections. I'm no longer on the board of Ashok Leyland or IndusInd Bank, so there's a small correction on the CV that was read out. So let me quickly give a overview of the situation in the economy and therefore the banking. Firstly, before COVID struck us, Indian economy was not a weak economy, but it was a weakening economy. If you just recall, a year before the COVID struck us, towards the end of the fiscal year 2019-20, we had witnessed a significant fall in the growth rates, quarter-to-quarter GDP growth rates. We saw that consumer goods growth was negative 1%, capital goods growth was negative 10%, exports was negative 1%, imports was negative 6%. Some of these are the benchmarks which were the lows in the record over 15, 20 years. And in particular, with reference to the banking sector, the bank credit growth was estimated to be somewhere in the region of 6.5% to 7%. I suspect that it is actually lower than the 6.5% to 7% growth rate. And this is probably the first time in my memory, at least, when the banking credit grew at a level lower, at a rate lower than the nominal GDP, which means that people were returning money to the bank. They were not borrowing money. And if you have a situation when credit is not expanding sufficiently relative to the nominal GDP growth, it means that the potential for growth, not merely the current growth, potential for growth is fairly under stress. Why did this happen? This happened because, partly because of the weakening demand situation. Industries were not investing. And if you are not investing, you don't require money, bank money, right? If you're not growing, if your demand growth is sluggish or negative, you don't need additional working capital. You don't borrow money. And therefore, there was no demand for credit from the manufacturing or industrial side. And from a personal side, people were not sure about the income growth. Only if you're sure about the income growth, you borrow from the future in order to buy a car or a house. Therefore, there was not enough demand from the personal side. So that was the situation pre-COVID. Not a happy situation. Not a situation which you could say is a position of strength from which we could have faced a crisis. If you recall, in 2008, the economy, when it faced the global financial crisis, economy was in a pretty good shape. The financial crisis was very severe, but it was able to meet that because the economy was in a better shape. Now, we don't have the same level of strength in the banking sector and the economy to face a crisis of this nature. That's the background. And then the crisis happened. The crisis certainly is something which is going to have a very significant impact on the banking system and the industrial activity. There are various kind of projections, all of them indicating that the GDP growth at best could be somewhere in the region of 1.5% to 2% positive to negative of nearly 1.5%. So that's the kind of forecasts that are being made. There is a risk that the strain experienced by the real economy, the manufacturing, the services economy, construction, all of that could spill over to the banking side, and we might have, therefore, what Arvind Subramanian used to call the twin balance sheet problem. The balance sheet of the banks being weak, the balance sheet of the borrowers being weak. That's a twin balance sheet problem. And therefore, there is a big challenge in front of both the economy and the banking industry. Now, it's often said that you should never waste a crisis. Therefore, this is a time when we really have to think about what can we do now structurally in order to strengthen the banking system and strengthen the economy going forward. The COVID-19 will pass. Mankind will find a solution to it, vaccine or antiviral drugs. So we will find solutions to it. And when we come out of this, we need to get stronger. And therefore, our focus must be to say, what should we do to make it stronger? I'll stop there and give it back to Ish and Kamakodi.
Thank you, Shesh. As usual, a succinct overview of this. Thank you. Kamakodi is very well known for his bank's beautiful rhyme. Rasiana Bank, Isiana Bank, therefore Rasiana Bank. So Kamakodi has been in the thick of transforming a rural-based bank into a technologically strong, vibrant bank, which is meeting the expanding requirements, particularly of the MSME sector. KK, what do you consider as an assessment of what Shesh said in terms of banking, your bank, the pre-COVID and the post-COVID situation?
See, thank you, Vishwanan sir, and thank you, Shesh sir. See, basically, when even in the last 20, 25 years, in one way or the other, if you look into the problems per se for balance sheet or performance or whatever it is, things started with your 99, 2000, 2001 slowdown, during which the all prudential norms and all were introduced. The slowdown, along with certain actions which became pro-cyclic, the system had close to about 15% gross NPA. In those periods, all banks were operating at with a credit deposit ratio of about 50%, and a lot of them were having a lot of government securities with them. When the bond yield started, government bond yield started coming down from double digits to about 5 to 6%, automatically there were a lot of appreciation in their bond books. Banks realized that gains, and they provided par. Subsequently, you had your the NPA ratios after that also from the range of even average of about 15%. It came down to about 5 to 6%. Then you had your Lehman crisis. As Shesh rightly said, since the overall general performance of the economy at that point of time was reasonably good, India was to greater extent out of that. Still, you had problem. And after that, next issue started, particularly with the AQR, the asset quality review. I mean, because of, like say, a lot of issues with your corporate consortiums, infrastructure, like say, the court decisions and things like that, it virtually made the banks to have, once again, the gross NPA getting back to about 15% or so. Now only things have started coming slowly, maybe just at the higher single digits or whatever. At that point of time, this particular crisis has stuck. Basically, if you just leave the virus and other things away, just looking at it as a financial problem, because in other way, you also had, after the AQR, you had the demonetization, introduction of the GST and all. Even during demonetization time, you had almost lockdown of most of the economic activities for a few weeks or maybe close to a month or month and a half. We are probably, but that should be maybe only a fraction of whatever you are seeing now. But you have something which is a new dimension to that is your risk of life and things like that. But if you just look into the matter as like say stoppage of economic activity, so what is getting very clear is that virtually almost all economic activity, be it a small company or MSME or corporates or whoever, they may have to take bulk of the fixed expenditure. Maybe they may have few cuts here and there, but bulk of the fixed expenditures will continue, but you will not be having any revenue per se. So which is going to create basically like people have to rely upon the whoever has reserves and all, they have to rely get into that reserves, but the others will definitely have issues. Even after the lockdown gets open, to have like say the entire manpower in place, particularly those manpower intensive industries which have a lot of migrant laborers and all, maybe some of them would have already gone, or some of them who may be here but they would like to go back and come back. To have everybody in place may take not less than 6 to 8 weeks. After that, having your raw materials, like say getting sufficient liquidity to the like say getting the receivables and all to make the machine running itself will take probably another 1 or 2 quarters. And for almost all business entities to get back to the cash flow positive, it is not going to be less than maybe 2 to 3 quarters. I'm not talking about anything else, just to have operating positive cash flow. After that, you have to go for your interest, or after that installments and all. The virtually the to have everything back to wherever we were in January or February, it is going to be only during 2021 March or so, when everything will be finally in place. So this problem is going to be there for almost all businesses, big or small, but the proportion will differ depending upon the like say the inherent strength of the business entities. Along with that, you will be having disruptions in the like say consumption, because like say there could be some job losses. All such things will complicate the issue, but by and large, to have everything back on track, it is not going to be a period, not anything less than 1 year. But during that period, probably like say how we are going to first ensure that it is going to be only addressed as a liquidity problem, and to ensure that it will not become a solvency problem subsequently. So for that only, already there are certain measures which are given by the government and regulators, be it form of regulatory forbearance or banks being permitted to give some extra liquidities and things like that. But what we have to understand is that we have only touched the tip of the problem. What is going to be the actual force with which it is going to hit us, it will be known only after the lockdown is taken off and the business entities are allowed to function and all. But since, as Seshasayee rightly said, these things will pass and things, the entire economy will come back to the normalcy with higher strength and all such things. But what we have to be very clear is that to get out of this problem, I mean, even after the like say demonetization, even though like say many of the small and medium scale enterprises had to be like say not working for a few weeks, but it took many months for them to come back to the normalcy and to have the full cash flow back on track. So as the time period of lockdown extends, the time taken to come back to the normalcy will also going to be extended period of time. But I hope with sufficient support from the policymakers and government and things like that, it's not just a problem of the India, it is the problem of the whole world. I think things will be taking its own time, but they will be coming back to the strength with improved strength as we get into the overall, I mean, as the time passes.
Thanks, KK, for the optimism. There have been a lot of predictable actions taken, particularly in the health, in terms of lockdowns and all, in various aspects. An interesting development this time also relates to Reserve Bank acting in time and with a lot of alacrity and speed in looking at the liquidity issue, the inflation issue, and also the value of the rupee. And that has been giving a lot of hope for things to be acceleratedly brought to normal. Shesh, you are looking at it closely as a banker of eminence. Do you think the measures taken by Reserve Bank adequate? What are your suggestions for further improving upon it?
Kamakodi talked about the issue relating to liquidity and solvency. Banks will be faced with a situation when their borrowers are strained, and as a result of their strain, they would not be able to repay their installments, and they would face the situation of lower profits or losses. Now, when you have inability on the part of the borrower to repay, then, as you know, this results in a non-performing asset, and there are norms in terms of recognition of the non-performing assets. The Reserve Bank has given the moratorium now, has given the right to the banks to provide moratorium for 3 months on term loans to borrowers. And as a result of that, the liquidity strain for the borrowers will be lower. They don't have to repay. So it's a good step forward by Reserve Bank in order to provide the necessary relief from the point of liquidity to the borrowers. But when you have the borrowers exercising this moratorium and not repaying to the banks have a different problem. The depositors want to get their money. There's no moratorium on the depositors. And therefore, depositors have to be paid when they want the money back, while the borrowers are allowed to have the moratorium. The banks allow this moratorium to the bank and to the borrowers. Therefore, there is a mismatch in terms of cash flow. What the Reserve Bank has done is to provide the liquidity. They've provided enough liquidity. I think it's nearly in all about 3.74 lakh crores, which is roughly about 1.8% of GDP, which is quite a sizable amount at this point of time. And there is specific liquidity measures being given for mutual funds, specific provisions made for MSMEs and so on and so forth. Therefore, liquidity is enough today at the moment. It's not a problem. Solvency is another problem. Generally speaking, when banks are faced with liquidity problem very quickly transfers itself into a solvency problem. So let's look at the solvency problem of the borrowers. The borrowers not having money to repay is one thing. The borrowers not having the demand, the inability to make a profitable business, and therefore becoming insolvent is another problem, right? To them also, to the borrowers also, liquidity becomes quite often, particularly in MSMEs, liquidity translates itself into a solvency problem fairly quickly because you don't have working capital, you can't run the business, therefore you run into a problem. Liquidity problems becomes a solvency problem very quickly. If that happens, then it also then moves into the bank's books because of NPA, as we said. The problem with the banking sector is that if there is one bank which faces a strain, the contagion effect of that is worse than the COVID virus. It quickly moves into the system if you're not careful. And therefore, the bank's NPAs should not overwhelm its capital. The capital adequacy was not bad. In fact, the PSBs had something close to about 12.5% or so. In all, the private banks had higher. In all, the capital adequacy was about 14% or so, which is not a bad thing at all. And therefore, there was enough capital adequacy before we moved into COVID. The COVID situation resulting in NPAs will bring down the capital adequacy because losses will have to be set off against the capital, bring down the capital adequacy. When the capital adequacy comes down and there is not enough capital accessible by the banks, that could result in a solvency problem. When confidence gets shaken and there's a run on deposits, typically liquidity problems becomes a solvency problem. Will that happen? I don't think so. Despite the problem, I don't think that we should worry too much about the NPAs climbing up dramatically. There are several estimates. The NPAs estimates vary from about 1 to 1.9%, which is not that alarming. And the banks being adequately capitalized at this point of time, and the banks having the access to liquidity provided by the Reserve Bank, I believe that there is neither likely to be a very high insolvency problem in the borrower's situation. There will be liquidity problem, but not insolvency problem. And therefore, there's not enough problems of solvency in the case of banking sector.
KK, do you agree with this? As a flourishing mid-sized bank dealing with a large number of MSMEs, do you agree with this point that the MSMEs won't contribute too much to the NPAs as envisaged by Shesh?
Yeah, I absolutely agree with Seshar. What he says is 100% right. Basically, like whatever lessons we learned in the 99-2001 issue and all, it had always been a liquidity mismatch for the small and medium scale enterprises. And if sufficient time is given to them to stabilize themselves and to see the cash flow through, I mean, the all these like say the regulatory forbearances like restructuring and all being given, I think like say it's only the patience and allowing things to settle is something which is needed at this point of time, and I expect those things will be like say happening properly without much damage to the overall system.
But KK, the problem normally with the MSME, their ability to tide over such crisis, because they've always been short of capital, they're dependent heavily on outside borrowings. And do you think they are in a comparable position compared to, say, larger industry to tide over this? Because I belong to the MSME sector. I know the pervasive problem affect them. Even the normal times, their survival or the conditions are not very, very happy. But in a situation like this, even if you pump in liquidity, will it meet their solvency problem?
See, I mean, bigger the entities, bigger the problems. So finally, it turns out to be whether the individual business entity has a viable business which it is able to manage. And normally what you see is that in banking parlance, it is always given as a willingness and the ability. If you add the like say give a proper thing, I don't think there is a yes, there are the problems are different. I won't say that the problems in the SME sectors are going to be bigger. Overall, on a risk-adjusted return basis, things are going to be perfectly all right.
Thank you, KK. Shesh, there are some complaints. The banks are not effectively carrying out the Reserve Bank's directions in terms of distributing the improved liquidity. The banks are normally extremely cautious people, and they have been more so in recent years after the barrage of criticism on them on various things. Taking no action seems to be better than taking any action. Therefore, do you think the directions and the suggestions made by RBI are implemented at the branch level?
Let me take off from where Kamakodi left. I mean, he referred to the fact that there needs to be willingness and ability. We talked about the liquidity being available now because of the several measures taken by the Reserve Bank. Actually, I would even say that we have now liquidity is awash now. Banks have parked more than 7.5 lakh crores with the Reserve Bank because they're not lending. And that's not surprising because in a lockdown situation, you're not going to be wanting more money because there is no business activity. You're not going to be wanting to create new capacity because there's no investments being made. So therefore, the demand per se is less, and therefore there's enough liquidity. Now, the ability is another. Ability, therefore, is being addressed by the liquidity. Willingness is another issue. Willingness is the bank must be willing to give because of two things. One is the bank is willing to give because the borrower has got a good proposition. It's a good credit risk, and therefore it's profitable to lend and make money for the bank and the depositors, right? So you have today a situation where the pipeline of good credit proposals is probably very dry. It was getting dried up in the last 12 months. I don't know whether Kamakodi would also bear me out from his experience, but my watch over what was happening in most private banks was that the pipeline of good credit proposals was drying up. Partly because there was enough capacity on the ground. As all of us know, most industries were operating in between 60-70% capacity. So nobody was thinking of new investment proposals. Therefore, the good quality proposal pipeline was low. Bad quality proposals, which is basically to say, give me more money because I'm making loss and I need to do the loss funding. Or I've got a dubious kind of a proposition for which I want the money to be lent. The banks are not willing to do that, and correctly so, right? Because the job of a banker is to take the call on the correct credit risk. Therefore, the credit risk is going to be more than what can be sustained by the bank. It is correctly rejecting those proposals, and therefore, banks are not willing to lend. And that's why the credit growth was only 6.5% or 6%, because the banks are not willing to lend. There were not enough good quality proposals. That's one part of the willingness. Therefore, now, in the COVID situation, post-COVID situation, are the banks going to be willing to lend? It depends on how strong the proposals are going to be. And I suspect that you will not have, for some time, at least another 2-3 quarters, good quality proposals coming in a big way. There will be some. For example, I think the essential goods are all doing very well, right? Groceries or eatables, or all of them are doing well. Pharma is doing very well. So there would be situations like that where there is a certain resurgence of demand and there will be some good proposals coming in, but a lot of banks would be going after them, and therefore the rates may not be very attractive for the banks to lend. But there is another element of the willingness, and that is being risk averse. If you look at the public sector banks, one of the issues that they've had is that they were unwilling to lend because lending is an unnecessary risk. I'm not going to be punished for being lazy, but I'm going to be punished for being risky, right? But without risk, you cannot run banks. You cannot make money for banks. You can't make money for the investors. You can't make money for the depositors. And therefore, risk-taking is inherent in the very purpose of banking. Therefore, there is a very fundamental issue of the unwillingness of, it's not inability, unwillingness, particularly of public sector banks, to go after credit marketing and lending. And that's an issue which needs to be addressed very, very quickly.
KK, you mentioned this, I described it till about the end of the year, Kamakodi. You mentioned that till about the end of the year, there's not much of a prospect for the economy getting back to an era of rapid growth. From the medium and small and micro industry sector, what Shesh described, Does it match there, or you find a greater degree of caution on the behalf of banks to lend for this sector?
See, what we have to now understand is that maybe for the next couple of quarters or maybe 2-3 quarters, the focus of the banks will be to take care of the existing customers to whom you have already lent. They already have, let's say, the COVID is already there. They already have issues with them and all. So the next couple of quarters have to be spent by the banks on understanding the problems of the individual customers and then make appropriate solutions for them.
Thank you, KK. Shesh, there has been a continuous problem on these NPAs. They have been mounting. What is your estimate over the period of time? What is your estimate of the NPA position? They are presently estimated around, say, 9 lakh plus crores. Do you think in the present COVID situation, will that be a concern, or they will allow it to continue to mount?
I think the NPA situation prior to COVID was in the region of maybe 9 to 10%. Without COVID happening in the normal course, I would have thought that that would have come down by a percentage or thereabout in the current year. The COVID situation would act between 1.5 to 2%. Therefore, I think it would be in the low double digits as we emerge out of the COVID situation. That's not a good situation, nor is it a disastrous situation. Because we have seen other countries, for example, China had double-digit NPAs for quite some years. Mid-90s, it had double-digit NPAs. Early 2000, it had double-digit NPAs. And these were declared NPAs. I mean, the suspicion of the world has always been that this was understated. But, you know, it's not a disaster. But when you are faced with that kind of situation, what is required is high growth. Because when you have good quality high growth, you digest these NPAs and it falls down. The denominator grows, the numerator doesn't grow that well, then the percentage NPA comes down, you're able to digest, which is what China did. China stepped on the accelerator, had very, very high levels of growth, consistent growth for some years, so the NPAs got absorbed. Now, NPA is a very natural kind of a phenomenon again in a banking business. It should not be this high at all. It should be much, much lower. I would have said an ideal situation should not be more than 1.5%, 2%, and having anything like 10% is a bad situation. But it's not a disaster situation. It can be corrected. It requires two things. It requires better capital. We need to get the banks in general to be more focused on capital. So one of the things that I have been recommending is that the government should come out now with the provision for about 50 to 60,000 crores as a part of the COVID package, which can be accessed by those banks which require capital. This could be by way of a tier 1 bond, convertible maybe, which could be accessed by banks in time to shore up their capital in order to be able to digest this NPAs. And the second is that the bank should step on the accelerator for good quality credit. This is a iterative process.
But say that 50,000 crore will be a drop in the ocean because the size of this will be in excess of 10 lakh crores.
I'm not suggesting that this is only for private banks, first of all, not for public sector banks. Public sector banks, 70,000 crores was budgeted last time. As I said, the public sector bank capital adequacy is not bad per se. It was in the region of somewhere in the region of about 14 or so percent for the industry as a whole, about 12% for BSBs. So it's not bad. So I was suggesting the 50,000-60,000 crores to be accessed only by such private banks which are in need of capital to shore up. And that could be, once you get the capital coming from the government, that will catalyze capital coming from others. It's like the way that S Bank happened.
Right.
You have some money coming from the bank, from the government. It is a statement of confidence that will enable the banks to capitalize from elsewhere. So 50,000 crores is more than adequate in my judgment. But that's one part of that. The other is that you got to grow. And in order to grow, public sector banks require a fundamental change, which is what I would say in the COVID situation we must address, which is to create a Temasek kind of an organization where public sector the shareholding is all vested there with the right kind of leadership, which can then focus on getting the right kind of talent leadership in the PSBs, right kind of technology, right kind of governance. With all that, banks will become then the instrument for coming out of this COVID situation. More than the government, the banks must play a key role in getting this economy out of the bind that it will get into.
Thank you, Seshasayee. An interesting thing to use the COVID situation as a game changer for disruptive and new phase of growth. Vijay, there should be enough number of questions waiting for the experts to answer. Please take over.
Yes, thank you so much, sir. We have received a number of questions. Let me go one by one, and based on the time availability and as desired by Shesh, we'll try and leave him as quick as possible. The first question is, RBI has given 3 months moratorium loan for repayment. Should interest for the loan period also be waived or concession to be given since the borrowers are not able to take care of this during this period because it'll get accumulated? So what is it? Do you have to waive the loan period during the moratorium period too? Any one of you can take this. Maybe Mr. Kamakodi, you would like to?
Yeah. See, the issue is once again the banks lend money to the borrowers from the money it is taking as deposits from the customers. But the interest meter still runs for the depositors. Hence, whatever money which is due from the borrowers, obviously the interest meter will also run. There is no other option.
Do you think the government will have to give some sort of relief in this sector because giving moratorium and getting him pay 3 months interest at the end of the moratorium period, thereafter interest, how is it going to work? Maybe government should look at it, your views?
See, the easiest part will be for the borrowers to continue paying interest, if not they are taking moratorium only for the installments. And also when the, let's say, sufficient cash flow happens, pay that immediately. See, the issue is like, where is government getting its money? Government is getting its money once again from the tax which is paid by the taxpayers. So if a government gives here, then governments will be deprived of money to save for some other better options. Right. So that government paying that cannot be an option on a sustainable basis. That's the problem.
Super, sir. Good. So there's also a question from one of our YouTube viewers. Recently, RBI has announced 50,000 crores line of credit to all the banks to support mutual funds so that investors do not lose. Have the banks taken it seriously? How the private banks are going to avail this opportunity?
It's basically individual banks are taking their call already on the, I think, first couple of days, about 30 to 40% of that limit had been drawn. Once again, the banks being the custodian of the public money, they will be taking a call depending upon which mutual fund, where it is going. So they will take some time to make this assessment and they will be taking a call.
Thank you. This is another question from the MSME sector. Mr. Devanarayanan is from MKC Finance. No proper support given to micro and MSME loan equivalent to 15% of the turnover, with a cap of interest rate of 7% payable in 24 EMIs as to be given by the banks to restart unit in government provide guarantee cover. Similar relief is given in UK. Liquidity injection by RBI is insufficient for the further the 2 lakh crore to be given by way of TLTRO. So your comments on this, please.
For me?
Anyway, sir. Maybe Mr. Kamakodi or Mr.
Kamakodi, you take it.
Sure. See, probably it may be on the cards. Like say, we are seeing in the TV repeatedly some amount of bigger package for the MSME and all are working. And the Reserve Bank has also said that it is not final list of the support given by the government or regulator and all. And they will be reviewing it on an ongoing basis, and they will be giving some more thing. We don't know whether this something like that could be on discussion. We also saw that on the TV yesterday that something on this line is being worked out and all. We have to wait and see.
So there's another question from one of you from Facebook. Since the exporters are not able to export on time, many of the contracts are cancelled. Should government or RBI assist them? If so, how? Which sector can the bank hope to lend, and which sector we should be cautious?
Finally, ultimately, these decisions have to be taken by the individual businessman only. So particularly on the first line, when there is like say the contracts have to be re-entered and all, whatever the difference and minor losses, I mean, it finally it will be on the like say head of the individual businessman only. But what banks and all can do, like say, if proper decisions are taken at all level, give an extended time period for the like say businesses to make profit and make repayments over a longer period of time, so that their short-term viability will not be in question. I think discussions are already going on this line, it looks like, and we may be getting something on that line.
Thank you. So, Mr. Shesh, you mentioned during your observation that MSME sector will do well, especially pharma industry demands are more. A question has come on that level. Do you agree that the latest demand in Indian economy with lesser import from China should give sufficient demand for Indian manufacturers, cost cutting, and how it can be done? Is there an opportunity for India because of China is getting into on the firing side?
In the immediate aftermath of this, given the fact that there is so much of anger against China and so much of vulnerabilities that have been discovered, in fact, yesterday I was in a conference call and I was told that even in the N95 masks, the most crucial component in that mask is almost 100% coming from China. So therefore, people are discovering suddenly the critical kind of dependence on China, and therefore there will be this flush of activities to unwind from China, and India has an opportunity. But we have to act pretty fast because we're not the only people who can do that. You have competitors from other Southeast Asian countries, Vietnam or Philippines and so on. All of them are waiting in the wings, and so unless we act very, very promptly, and this is not about government, it is about individual companies keeping their ears close to the ground, finding out what are the kind of opportunities, and then get into it quickly. It is in wartime that people have suddenly found the new opportunities for change. A Toyota became a car manufacturer from a textile machinery manufacturer because the wartime effort threw up some opportunities. Today, automobile companies are manufacturing ventilators. So you have this kind of opportunities coming up. Entrepreneurs have to keep their ears close to the ground. But I don't think that it is very right to think that you will have a big queue standing outside the door of India wanting to pour investments into India because China has become suddenly unpopular. I'm sorry, I wish it happens, but it will not happen.
Thank you, sir. You know that the exports are very, very important for recovery. So a question related to the export is the forward contracts. Maybe I think I request both Ms. Kamakodi and Shesh also to share his insight on this. The forward contract, the exporters are booked in advance. Now, many of the contracts got cancelled because of situations. But when it comes to payment, they have to pay at what is the current rate in terms of dollar. So do you think the bank or government should interfere to protect the exporters' interest in these regards?
That's what I said in the beginning. like say this is a business call, and these sort of things have to be handled by the respective businesses only. It's the governments cannot take a call on this area on a sustained basis. There could be few aberrations here and there, but I don't think governments will be in a position to take this sort of call on a sustained basis.
Shesh would like to show maybe the government should give more support to exporters and protect their interest for there is no fault of theirs actually at the moment.
I broadly agree with what Kamakodi says. When we are all in a stress, we will look to government to come and bail us out. It has happened in other countries. US and UK have been very generous with their kind of support. Japan has not been that forthcoming. They're still about 1.5% of the GDP in terms of support. So it is natural to say that it's not my problem, so therefore bail me out. But unfortunately, Government of India does not have the kind of wherewithal to bail us out. We must remember that the total budget size of Government of India, Central Government of India, is only about 10% of our GDP. Therefore, you really cannot go beyond, say, 1.5%, 2%, maybe 2.5% maximum in terms of support. Yes, MSMEs deserve more support than any other, because they are vulnerable in general, but this is not going to be sustainable.
Still, we have a few more minutes. We'll choose in as many questions as possible. So we got a number of questions. How about the recruitment scenario in banking industry? Will there be any recruitment freeze, or how are we going to look at it? Because
let me take that question, because I participated in a debate some months ago, much before the COVID situation happened. And my theory was that the employment in banking will keep coming down. Year after year, it will keep coming down. It will keep coming down because more and more digitization is happening. The extent of back office work, which used to be done with a lot of human beings, are being done by automated office systems. Therefore, the intensity will come down. And in general, after COVID, people have realized a lot more can be done digitally than physically. And this is going to happen for banking as well. In fact, I'm prompted to answer this question because I found very interestingly one of our own friends groups, a lady who was alone in her late 70s, who was not at all comfortable with the technology, other than using just a smartphone to connect with her children in the US. She's doing banking now digitally. So therefore, this is going to happen. And therefore, the employment intensity in banking will keep coming down.
I'll add to this. Sorry, I'll add a line to this, Vijay.
yes, sir.
With the merger of banks, big banks, you have the situation of the same bank branches side by side for 3 banks in a row in the same street. At some point of time, there has got to be a lot of rationalization. But it's a very technical question. The government has to be answering the pressure by the unions. In the last 50 years, the unions have gone so strong that they have been dictating many of these terms. And this type of rationalization which is anticipated is not on the cards yet. The big companies like Boeing and McDonnell Douglas in the US, or our own Indian Airlines, Air India, the merger didn't work largely because of the inability to rationalize the workforce and take the benefit out of the merger. So banks, when they are merging in a big way and are also looking for privatization, and also with digitalization mentioned by Sesh, and the information technology so beautifully employed by banks like City Union Bank, there is the case for the banks drastically. I am sorry, as a journalist, I am saying this, the people will pounce upon me, I know. There is a need for rationalizing it in a big way. And there is also another sad factor that at the time of nationalization, a lot of young blood came into banking. Today, over a period of time, the average age in banking has also become fairly large, and it is difficult to train them in new technologies.
Thank you, sir. We got a number of questions. I'll try and fix as many questions as possible. There's a question from Mr. Anand. Is it time right for the common regulator for banks, NBFC, and mutual funds with the current situations?
I think certainly yes. In fact, UK had moved into a unified regulator quite some years ago. This has been in discussion in India for some time now. Certainly, there is a need for a common regulator for insurance, banking, mutual funds, and so on. But there is now a forum in which the regulators come together periodically and sort out the issues. It is not as if that they work in silos. There is a lot of discussion that takes place. But yes, a unified financial authority, regulator for a proper organization and development of the financial sector is absolutely the right thing to do now.
So there's a question from an MBA student from Pondicherry, Mr. Vetrivel. After the impact of the coronavirus, can we have opportunities for MBA students in banking sector? So please, we're all confused. We don't know what is our future.
I don't see why there is any question at all. I mean, first of all, Mr. Vetrivel, I must tell you that if you're an MBA, why are you worried about one sector? I mean, you are essentially being prepared to look at any sector wherever there are opportunities. And for sure, there will be opportunities in banks. It's all about competition. It's all about making sure that you have the right kind of skills, the right kind of innovative spirit to do your job wherever you are. Captain, I have to sign off in 2-3 minutes. I have another call.
Yes, sir. One last question, sir. Before that, and maybe you can sign out. Maybe Mr. Kamakodi will be able to take a couple of more questions. Is it possible, sir? Yes. So this gentleman is from MBA banking. One last question, sir. Does banking automation going forward mean that the new banks are not to be expected to enable last mile connectivity with the AI coming in a big way due to cyber security and other issues? Do you mean say it's going to take away the jobs while it thinks? And is it AI introduction in cyber security? Is it more secure, or is it also going to be a serious issue?
I think there are several questions all bundled into it. Let me just try and disaggregate this question to the extent that I can. Is this going to mean, is the future of banking going to be less labor intensive? I've already answered. Yes, I think a digital bank will have much less people than a physical bank, and we will be moved from the brick and mortar situation to the what we call the click situation. Not overnight, not Monday morning. It's not going to happen, but it'll happen fairly early. That's number one. Second is the cyber security an issue when it becomes more digital? The answer is yes. Cyber security is a very pervasive issue which affects all the sectors, and most certainly the banking sector. But there's a lot of technology development that's happening in cybersecurity. So there is always this race between those who want to hack and those who are preparing or developing anti-hacking methodologies. There's always a permanent kind of a race, but that's not going to hold back digitization. It will continue. And lastly, AI. There's a huge potential for AI. Including in risk assessment, which it is slowly creeping into. There's a phenomenal work that can be done with the deployment of AI, but that's a subject by itself. So,
yes, sir. I think we answered all the three because I want to fit in as many questions as possible before we leave. Anyway, we come to the end of the session, sir. Most of the questions have been answered. There's one common question which so many people are thinking, which I thought I will combine and ask you. There's a view of a public sector bank is more optimistic, while a private sector bank, what they have been seeing in regular television, they're more pessimistic. They're more concerned about NPAs. They're more concerned about opening as quick as possible. While we see the public sector bank, they say we are more optimistic and they say a lot of opportunity in this. Is it because of social mindset of the public sector undertaking, or the individual who commented during the TV program makes this understand? So I want your views because you represent almost everything, Mr. Mr. Kamakodi, the private sector bank, the shares representing the industry, which has got the national interest. So what is actually the views? Is it because of, why is there a difference in view between public sector banks to the private sector banks?
So let me just say this in broad terms. If you look at the PSPs, public sector banks, numbers, their NPA situation, and the private sector banks, their NPA situation. I mean, if you just look at the NPA, private sectors is somewhere in the region of 5 to 4.5 to 5. Most good private banks have less than 2%, 1.5%. Whereas the public sector banks NPAs is in the region of 9 to 10%. Some of them much worse than that. So if you look at the numbers, if you look at the capital adequacy, if you look at the profitability, you would find that the private sector banks in general, I'm not talking about any particular one, in general, in aggregate, fare better than the public sector banks in aggregate. In fact, you go to the economic survey of Government of India, published before the budget, and you will have this very eloquently explained. But when you have a crisis of this nature, the tendency is to run for safety. People go to dollars. They're moving out of other currencies. Why? Because dollars seem to be a safe currency. You're running for safety. And therefore, a public sector bank, because it is government owned, you have this feeling it's a safe thing. Government is not going to fail. If government is going to fail, everything else fails, right? And therefore, the feeling of this instinct for security is what this is sentiment and instinct. It is not numbers. It is not rational. It is not logical. But it will be there. But I think when things cool down and people then come back to numbers.
Thank you, sir.
Okay,
Great.
thank you very much. I think it was
thank you so much, sir. Sorry,
being part of this event, and keep it up. I see that you're so active. As I said, you were busier than usual, but that doesn't mean that the COVID should continue. I think you've got to get less busy, and let's all hope the COVID shutdown is lifted as early as possible. All getting back to work. Thanks, Vish, and thanks, Kamakodi. Nice of all of you to accommodate my having to sign off quickly. Thank you very much. Bye.
Thank you, Sesh.
Thank you. Thank you all.
Bye.
Yeah, thank you.
Before we close, Mr. Kamakodi, would you like to share your views on the comment on the public sector bank with the private sector banks? After that, we'll close it.
See, by and large, Sir has answered that question in detail. It's basically like the perception like half empty and half full. It also looks into the what you call the margin of whatever the acceptability. Like say for different people, it works differently. So that's precisely what Sher has answered. That's the by and large reason. Nothing else.
Thank you so much, sir. You've been kind enough to share your insight on many things. We come to the close. So many questions more, but I think we'll have another session, another day post-COVID, so that we will be able to more optimistically respond to the question. And Mr. Viswanathan, thank you for facilitating. Would you like to share your closing comments before we come to end, sir?
Thank you so much. We are only hoping that we are going to convert this big challenge into a great opportunity. As an optimist, I have been all through. I do expect this crisis. We act extremely well during crisis. I hope we are learning the past mistakes and make use of this crisis to be much stronger and win the world. Thanks again for this opportunity to interact. Good day.
Thank you so much.
Thank you for both Vishwan sir, Sher sir, Vijay Kumar, Yamami, and all participants. Thanks for the opportunity. Thank you.
Yeah, thank you so much, ladies and gentlemen, who have participated in a large number, and all of our viewers watching this program live on YouTube, Facebook, and also our live webinar. And thank you for putting in so many questions. This clearly indicates how closely involved with our event. But unfortunately, we have fixed time, and the speakers got serious engagement. They have to move on. But all your questions are there. We'll try and pass it on to them and get the answer if possible and put across. Thank you. Keep learning. Stay safe, and look forward to see you soon. And Mr. Viswanathan, as usual, thank you so much, sir, for facilitating this excellent program. And thank you. Take care and stay safe.
My pleasure.
Yeah. Bye-bye.
My pleasure. All the best.
Yes, we meet again at 6 o'clock this evening and another event. And if you are not stressed, even stressed, do come and attend because the Swamiji from Rajkot, Gujarat is going to share his insight, which will be a great, great insight for you. Look forward to seeing you this evening at 5:45 p.m. Have a wonderful day. Bye-bye. Till we meet
Thank you.
again. Goodbye.
Bye. Thank you.
Shankar, all close? Fine.
Sir, close, sir.
Okay. Thank you.
Thank you.
I think
Thank
went up
you,
well. The clarity was quite much better.
Okay, sir. Thank you, sir.
Thank you. Bye.
Bye, sir.